Hello everyone, I'm Giorgio Tavazza and you're watching Avanguardia Investment Media. Today we are joined by Tavi Costa, member and portfolio manager at Crescat Capital. He is responsible for the creation of Crescat's macro model and we are fortunate to have him here today. Tavi, thanks for joining us.
Thanks for having me. Looking forward to this.
Perfect. So let's jump into it. You have designed Crescat macro model with the objective to identify the current stage of the US economic cycle. What's your model telling you right now? And at what stage of the US economic cycle are we in?
I think there's a lot of things going on that. First of all, I think we're very late in the business cycle, just to answer more simplistically speaking. Apologies, my voice is a little bit different because I got sick over the weekend, but let's get into the markets. I think there's a few things going on. Number one, most leading indicators economically show that we're probably going to have a very steep recession in the following, call it 6 to 9 months. Then you have labor markets, which are lagging indicators. Too many people focusing on that, and that's yet to translate into or reflect that part of the problem. And those are very, very good indicators. I mean, unemployment being one of the lowest records in history, or levels in history, certainly is as contrarian as it gets when it comes to a sign of the economy being at the peak of the cycle. Then you have valuations. Valuations were extremely high about, call it 9 months ago, and things have been repriced. So in terms of that, I don't think the equity markets are at the peak of the cycle. So you got to separate the two. The economy is turning, but the market's already turning a lot quicker. And so I think I've always had this bearish bias in markets, and which hurt me for the prior, 3 years or so. And that's mostly driven by valuations and, this view of us entering in an inflationary environment and knowing that usually that's not positive for equity markets over the long term. And you throw on top of it the valuation problem, which even now with things being repriced lower relative to 9 months ago, we're still very high valuations historically speaking. And it's very broad. It's not just one sector like the tech bubble was. It's actually broadly speaking on staples. You got consumer discretionary, utilities look expensive. So there were times back in 2008 where, when the banks got crushed, you had Walmart and some other staples that did okay. But you look at the balance sheets of those companies today, like the McDonald's of the world, they're all very, very heavy balance sheets. They got really indebted over the last, call it last decade. So you've got all that happening at the same time. So to answer the question, I think we're at the very peak of the business cycle for the economy. And I think we're seeing that already playing out in equity markets. There's a lot more downside in my view. I think you're sort of in a transition now in the equity markets where there's two types of macro guys. One type, which is really focused on technical short-term indicators, which literally everything looks oversold in equity markets. And then you have macro guys looking at the big picture and thinking, look, there are no signs of a political shift in terms of the Fed and even fiscal. And so if we're not seeing a change in tune and policy stance, that doesn't create a bottom. And so it's very difficult to navigate. I am joining the guys on the policy making side. I think we can see, liquidity is drying up. I think we can see a very steep decline in equity markets, even though things are already oversold. And, remember those oversold levels, usually when you reach those are actually the times when you see those flushes in markets. I think we can see one of those. We're positioned for that in our portfolio right now, but it doesn't need to be a flush. But I do think there's a very high potential for that.
Right, and one of the questions I prepared for you was about one tweet that you recently shared, in which you said, "I'm starting to think that the next leg down in stocks could look like the 1987 crash. Liquidity is drying up, Nasdaq is about to break support, and the Fed is not stepping in for now." And the why of this reasoning we already seen in your recent response and answer. How could investors safeguard their capital from this type of event?
Well, it's tough. Look, what we've been doing is actually very sounds a lot simpler than what it is, but I think it's fairly simple. It's just different ways to skin the cat in that front. But to me, it has always been, if you are of the view that we're entering an inflationary environment and you look at valuation of things that usually tend to perform well during those times, it's really interesting. There's a lot of macro trends to be unleashed still. So, first of all, I think the commodities to equity ratio is the one thing that I'm mostly trying to replicate as a position in the portfolio. So I want to be long commodities. I want to be short equities and financial assets that are expensive. Um, those financial assets have been many things. I've been short treasuries. I've been short even currencies that I thought were worse in the US, like the Japanese yen. I wish I was short a lot more than what I was. I was short technology companies. And now I'm shifting away from some of that and focusing more on mega cap, like Apples of the world, the Teslas of the world, the Microsoft of the world. Those look really attractive right now as a short, because and some consumer discretionary too, because they haven't hit that support level that Nasdaq is at right now, and they still have more to go. And so I like those as a short, as an opportunity for people that are not into shorting or are not allowed to short or whatever. We continue to look at commodities as an opportunity. This is very a little bit contrarian because I think a lot of people are seeing, but if you have a recessionary view, why would you be long cyclical commodities? And it's difficult um, to really describe why, but to me, it's actually very simple. It's the capex trend for most commodities is still very low levels, historically low levels. In fact, relative to GDP, I put a chart recently on that. We're now at historical lows. And so if you have a situation like that, it's hard to believe you're going to have, enough supply and that overspending in infrastructure of commodity producers that causes the end of a cycle. We're not there yet at all. And so it's hard for me to be bearish on oil. The oil should be absolutely getting creamed right now. I mean, China is blowing up. The U.S. is selling strategic international reserves, petroleum reserves. You have the dollar moving the way it is. You have interest rates moving the way they are. It's crazy to think that the oil is still holding up, and there's a reason for that. The reason is the market is really tight. So to me, commodities is a buy the dip mentality. Equities is a sell the rally mentality. So I like Brazil for that because I think it's a very commodity-led economy. Now you got the kind of political green light on top of it because you have a gridlock. Even if Lula comes in, it's not really a huge deal as he used to be. And so you got a lot of that going in favor. Precious metals look very interesting too. I mean, I still like to own gold and silver, and we continue to build a very large portfolio there. Mining is the most inefficient market I've seen in the markets right now. And agricultural commodities look attractive as well. So that's the long side paired with a bunch of other shorts. And that's really the way we've been able to be up this year. Very, still up like 30% this year. And that's, I think there's a lot more to go. I mean, I think that's the best portfolio positioning for the following years.
Nice. Thank you for this answer, because I think it's really important for folks to understand I think a lot of people have this big dilemma. On one side, they know that we are in an inflationary environment, so they would like to protect their portfolio from inflation and going long commodities, precious metals, energy. On the other side, we have the Fed, which is raising aggressively interest rates, which could crush equities. So your solution to that will be having a long-short portfolio in which you are long inflation hedges in a certain way, and at the same time, you're hedging the long position with the shorts on overvalued mega cap like Apple, Facebook, Meta, and so and so, which makes perfect sense and has worked great this year. So talking a little bit about gold. In my last interview, I had the pleasure of speaking with Michael Howell. I don't know if you know him, and he's perhaps the #1 liquidity expert in the world. And he said that gold is not an inflation hedge, but a monetary inflation hedge. In other words, gold is a hedge against the largesse of central banks. When they print money and they expand their balance sheet, gold goes up, and when they shrink their balance sheet, gold suffers. So first of all, do you agree with him on this definition? And what do you think is the role of gold today for investors in their portfolio?
My definition is actually very similar. I think it's a hedge on monetary disorder. So, I think we went through a world where central banks had to accumulate assets to improve their quality of international reserves. I think of central banks just like a company, and their assets is literally their balance sheet of the company, and you have the earnings of that business and the cash flows, which are mostly, in my opinion, the trade balances and so forth. So when you think about that, you got countries today that are net importer of commodities. They're going to have very tough earnings. And so probably it's going to be pressuring their trade balance to be reduced. Some of them are going to have in major deficits. That's what you're seeing in Germany. And you may see that in places like Japan. And that's what the currency is moving at. And you might see even that in places like China, which are net importers of commodities. And on a net basis, you will see that being damaged. And then in order to kind of mask that problem, central banks have to improve the quality of their reserves, improve their balance sheets, look strong. And there are ways of doing that. In the last 20 years or so, or I would say even go further, maybe even as long as maybe 40 years, we've been through a period of that progressively countries have been accumulating US dollars, mostly US treasuries, in order to attract capital. And that has been a very successful way of doing things until the US got as indebted as it is right now. And so you're really buying debt from another indebted economy. And I think we're going to go back to a world where central banks have to accumulate even higher quality assets to attempt to improve the credibility of their own monetary system. So you may see central banks are starting buying gold as one way to, and it's hard to believe because most millennials and younger folks and people of the last 20 years have been focused on crypto, or call it the last 10 years for crypto, but focus on the drop in interest rates for the last 30 years. So it's a transition, and so that is causing major changes in correlations in markets. So you have global bonds declining and you have gold holding up very well. And to me, I think it's hard to believe that gold is going to have a downward 10-year performance from here. So when you have that view, knowing that there is a high probability that central banks will be forced to buy that as we see monetary systems collapse or just fail in general. It may be from frontier markets. It could be from developed economies. I'm very concerned about net importers of commodities. China is a great example of that. Hong Kong is a great example of that. And so we've been looking for shorts that have not yet played out that look interesting. It's really buying volatility for cheap right now. And I think that's one way to do it. But to answer your question, it's just gold hasn't really played the monetary role it used to in the past. And I think it will. I really do. I've been of that view for a while. And just to give you a sense, that's how everything started from, or mining portfolio focus on exploration, because I was of the view, look, I can't see gold trading lower, let's say at 1200, or lower than 1,000 10 years from now. I think gold's going to trade a lot higher, but I can't really get rich buying gold. I mean, gold is not something, it moves, exponentially. So how do I play that with leverage without using actual leverage? And there are many ways. Your first reaction is silver. You're like, oh, let me buy silver. And that was a fine way for me for a while. I still love silver. But then you look at producers and you're like, wow, that there's maybe a way I can just buy the miners and I can get that leverage. And you get into the developers, higher risk, better returns. You got to understand how to develop a mine. You have to understand how to financially structure those. And there's a lot of financially savvy guys in that part. And then there's another world that I had no idea about, which is the exploration side of it, which those are the true inefficiencies where guys will buy literally a property and they're going to drill and look for gold. And a lot of them have found gold, have found silver, have found copper, but because no one's focusing on those assets, even though you've got a probability of that discovery being a lot more defined than it was 2 years ago, the price of the asset has not changed. So you're able to buy those for cheap, literally pennies on the dollar, when there's a very high probability that those could be unicorns in the technology world. We call unicorns when they get to $1 billion company in terms of market cap. That's what I see. I'm like, or I can build a venture capital model where I can buy a bunch of those assets. And while everybody's focused on one hero and a bunch of zeros, I can get a lot of heroes, hopefully, through the high probability of discoveries not being priced accordingly. And, that's to me how everything got really interesting from a macro, but also an investor's perspective. And so to me, that's the best opportunity in 5 to 10 years. So it's building a business on a long-term trend that I think has a lot of legs to go. And, and you got Wall Street Journal saying that gold lost its status and things like that, which make no sense.
Right. And of course, this can be viewed as a contraindicator because many times when they come out with these news and these headlines, eventually they're proven wrong. So for the average investor that it's not a geologist and cannot grasp all the nuances of investing into explorers, what would you say is the best way to get exposure to gold? And that's the first part of the question. And the second part of the question, I think it's important for people to understand that sizing is important. Because many times when people see interviews, when people talk about gold or silver, they think, oh, right, I'm just going all in on gold, all in on silver. And then they experience what we've been experiencing in the last months and they get destroyed. So the first question is, what are the alternatives way in which investors can get exposure to gold? And the second part of the question is, what do you think is a good percentage-wise of the portfolio to allocate to gold to have a good risk-adjusted return for the next decade? Of course, it depends on the risk factor and the investor, but on a general way, what's your view on this allocation sizing?
Oh, well, number one, I think gold is a new treasury when it comes to protecting portfolios. So let's say you're holding a portfolio where 40% of your portfolio was treasuries. I would basically look into replacing a very big chunk of that and putting into gold. By the way, I'm saying this, but I'm actually long treasuries for the short term because I do think they're oversold. I'm a macro trader too, and I'm trying to play some of those swings. But I think treasuries are going to go lower over the long term. And if you're a pension fund that needs to carry a liquid book and have to be locking into a position for many, many years, I would favor gold over treasuries 100%. So, if you're dealing with a person who's got 40% of the portfolio in treasuries, well, I would consider drastically changing that and adding gold to the pie, whatever that is for you. If that's the 40% of your portfolio should be in gold, well, that's fine. You're not going to get rich buying gold. I mean, it's just not how the asset performs. It's a true, and you're not going to get rich buying treasuries. Let's just put it that way. So, it's literally, they work very similarly, but you're in a macro environment that favors gold over treasuries, in my opinion. You can create a spread trade, buy gold, sell treasuries, and that's one interesting one. I'm not doing that, but I can see it working. It worked in the 70s where interest rates went higher with gold going higher. So, but I think, like you mentioned, I think you start with the question of risk, right? If you're okay with the risk, and you want to go a little more, you want to take a little more risk here. I think silver looks just stupidly cheap, but I've been saying that for a while, and it's just in macro, you just never know what the triggers are. Like I was long oil, silver, gold, copper, agricultural commodities, 2-3 years ago, and I never thought oil was going to lead the way. I never thought agricultural commodities would lead the way. I thought silver was going to lead the way. But does it matter? I mean, I still got it right. It's just silver went sideways, basically, depending on when you bought it. And gold is basically sideways too, maybe lower a little bit. And so you just don't know when things are going to turn. Like you got Brazil play, right? The Brazil play didn't work. And then you got elections. Everyone is worried Lula's going to come in. And then, oh, guess what? There's a gridlock and the Petrobras is up 10%. Things happen very quickly. And then you lost it. You missed the whole opportunity because you're too worried about the trigger when you should be accumulating as a value investor. That's why I like value investors, is because they have patience and they accumulate over time. And to me, that's the key here is finding those big macro trends and keep buying them. And you never know which one's going to lead the way. I have my opinions, I do, but it's, obviously oil had a big move recently, and it's going to be harder to make money on it. And you have copper been consolidating for a while, but then you have a view about the economy collapsing. Yeah, copper can get caught up on that. Now gold is starting to look a lot more attractive in terms of that, because the global economy implodes. People are going to start thinking, all right, well, the Fed can't be doing this for too long. Then what happens next? Well, the Fed changes their tune, then gold moves. So, things are looking more attractive. But as a portfolio manager, I think you just want to hold a basket of those things. Now, I think the miners look extremely cheap. I said the inefficiencies in the parts of the market. I do think the developers look exceptionally cheap right now. I have a niche in exploration, and I'll keep staying there. But for folks that don't know much about mining, don't know much about, geology in general, I think you can navigate the development phase of a mining company. It's a learning curve. You got to learn about how to those deposits become economically viable, the de-risking process of getting approvals, and the free cash flow initially as they get into production is not consistent, and you just got to learn those things. It's just part of the game. What companies used to budget 2 years ago for capex is not the same capex right now. It's 2x more. That's why they're so cheap. There's no free lunch. So, if your capex used to be 300, 400 million and it's now close to $1 billion, of course, you're going to be down 50, 70%. That's just the nature of it. So you've got all that happening, but it's getting to a kind of too depressed level in my view. And so I think those developers look really interesting if you want to take risk. Exploration, don't mess with it if you don't know a geologist. And I would not mess with that at all. For us, we're very lucky. We work with one of the smartest guys in the industry. There are a few other guys, to mention, but it's just, there's a reason why this is so inefficient, is because there's a lack of folks that understand the business. So that's the other part. Then you get into, the producers are cheap as well. I mean, they're paying high dividends. It's not why you buy a mining company. They're just paying dividends because they're desperate. And that's when you want to buy people or buy companies, is when they're desperate. They're desperate to attract capital. So they're doing buybacks, they're doing dividends. They're doing that in a way combined that is higher than what they're doing on CapEx. And I think Ken Ross put out that they're going to be buying about 8.5% of their floating shares every year. And that's nuts. 8.5% on top of paying dividends. I mean, that's crazy. So you have, that opportunity. And then if you're not into the risk of running a mining company, royalties look really interesting. Royalties are lower risk. They obviously have less employees because there is no employees. Basically, it's a much smaller company running almost like an investment firm. And you were getting royalty deals and streaming deals and so forth. And that looks really interesting too. But it's not where you're going to get your higher returns. So it all depends on the risk profile of the person. I hold maybe very few royalty companies. I hold a few of the producers. I have increased my exposure to developers, but the big chunk of our portfolio is in explorers, because if you are in the beginning of a bull market, and just call it, if you've got a bull market from the long-term 5 to 10 years bull market, in this, exploration is by far going to, in my opinion, outperform the other parts of the industry. But again, it requires more knowledge. So yeah, I think the developers is probably a doable risk-taking a part of the industry that I would mess with if I wasn't doing what I'm doing.
Thanks. And so talking about currencies, the dollar has been performing incredibly well this year. And while a stronger dollar may help the US to lower inflation, it may also endanger company earnings, as you said before. What's your current view on the dollar? Do you think it has more room to rise or not? And what's your macro view about currencies and the dollar right now?
It's definitely not the top thing in my mind. I'm long the dollar in different ways, but it's like when I was long oil months ago, and I was like, I have that view long term, but I understand it had a big move. So it's like gravity, it went up too much in the short term. It's going to be much harder to make money now. Sort of why I'm long treasuries. It's more of a hedging position, short term in our portfolio. I like the dollar against the CNH. In other words, the Chinese yuan. I think that still looks really attractive. I really like the Hong Kong dollar trade because you don't need to get it right. Volatility is like 2% right now, implied for the next year. And I think we're entering a world where you can see some major debags of currencies, like we saw back in the 90s. Like when China had to restructure their banks back in 94, the Chinese yuan lost over 1/3 of its value in one day, right? In the course of a few years, it was a lot more than that. So that is unthinkable right now. It's very possible though. So I like those trades. The euro and the yen and so forth, I don't know. It's not so much in my mind right now. I find it interesting the breaking correlations of things like the Japanese yen and gold. Remember when gold and Japanese yen were the safe havens and so forth? Well, not anymore. So yen has collapsed, and even that gold held up pretty well. And I pay attention to those things. It's like the Brazil trade. I like Brazil, the Brazilian real. relative to countries like Japan, relative to countries like China. So the Brazilian real crossed with most developed economies that are net importer of commodities. It's a very interesting trade. I don't have it right now. Well, indirectly I do, but it's not a direct play. And I'm considering it because I look at the long-term chart of BRL, JPY, or Brazilian real versus Japanese yen, Brazilian real versus CNH. It looks really attractive to me. I mean, just as a total chartist, just looking at the chart, it looks really interesting. Makes sense from a macro perspective. It's not a cheap way to, not as asymmetric as, let's say, shorting the Hong Kong dollar, but you can put the trade on with the Hong Kong dollar. So you can be long Brazilian real and short the Hong Kong dollar. You got the carry on your favor, and you can pay for that on the short side of the Hong Kong dollar. So that looks interesting as well. I don't know. I view the world. I think I said this a while ago, not too long ago. The world has kind of gone into three places. You have countries that are protecting the cost of debt at all costs almost, and the cost being the currency. So that's really Japan. And now, the Bank of England doing the same. So that's kind of interesting. So they've lost value of the currency over time. But they're trying to hold up the value of cost of debt. Obviously, Japan have done a better job of that recently. While I may think that that's unsustainable, that's what they're doing, right? They're holding up the cost of debt and letting the currency go. And then you have the other section of countries that are holding up the currency level, but letting their treasury market go, or their debt levels, or their fixed income market to go. That's the US, fighting inflation at all costs, basically. And that creating those interest rate differentials and giving pressure to the dollar to rise. The Brazilian real is happening very similarly. And I mean, if you just think about it, the amount of reversal in policy that we had recently on the Federal Reserve side, if you look back in history, the Brazilian real should be collapsing, but it's not. And there's a reason for that. It's because it's a commodity-led economy. It's because it's entering a different environment. It's because it's crazy cheap. And it's because correlations are changing. So pay attention to those. And then there's a third bucket of countries. The ECB is there. ECB and other frontier economies. Canada's there as well. Maybe China is more there as well. I guess could be more uniquely in trouble, but it's kind of in the third group, which is they're letting both things go. They're letting their bond market along with their currency market, and that's unsustainable. I mean, I don't think that that's sustainable. And ultimately, majority of central banks are going to have to join the BOJ, right? And suppress cost of debt, because most developed economies have too much debt. But also, ultimately, that's also unsustainable. And they're going to have to go back to where the ECB is, which is having both bond market and currency market collapse. But I'm talking about long term here. This is roadmap for 5 to 10 years. Who knows what the time frame will look like? I don't think will happen now, but that's kind of what's in my mind. I think there are some countries that need to protect their currency and their bond market at some point. So you're seeing the BOE starting to do that. We may see the ECB do that as well. And eventually, it just both will go, meaning the currency and the bond market cannot be sustained at those levels. And that may happen in a second wave of inflation problem and so forth. So just not in my mind as much as it was a couple months ago, I guess.
And of course, in this context, it's understandable why gold is fundamental inside somebody's portfolio, because it's an insurance against all of this. Knowing the debt levels that the US has and most developed countries have, gold is an insurance against all these debt levels that cannot be sustained for the long term. So, Tavi, thank you so much. This conversation has been incredible. I'm sure people will love it. Where should people go to learn more about you and the work you do at Crescat Capital?
You can find my work on Twitter at Tavi Costa, or you can find my work in the website crescat.net, where we put out letters, very in-depth letters of reviews, and you can find those there under letters, investor letters. Yeah, those are the best ways to find my work. But thanks for having me.